and the basic journal entries for sales on credit, which we've already done in previous chapters, most of this. So hopefully it's a refresher, and then we'll dive into some of the new concepts presented from the chapter. So a receivable is just when a business sells goods or provides services to another party on account or on credit, meaning that they've sent them an invoice rather than collecting payment right away. And so the receivable is just a monetary claim against that business or the individual, saying, we have the right to receive this money from you in the future, and if you don't pay it, we have legal action to come after you and to collect it. And so that's what we've done in previous journals in previous chapters when we hear something like, we performed services for so-and-so on account, or we invoiced a company for providing such services. So accounts receivable is the one that we've already seen, and that's a shorter term type of receivable. So typically we anticipate collecting it within 30 to 60 days. And because it's that shorter time frame, it's reported as a current asset on the balance sheet. Alternatively, there's a notes receivable, with the main difference being that it's typically longer term. So it a lot of times might go even past a year, but it doesn't necessarily have to be a full year. It could be shorter than that, but a lot of times it's going to be longer. And it typically carries interest with it. So the accounts receivable, we're just saying, we've invoiced you for whatever, $100, and now we want you to pay us $100. Whereas with this notes receivable, or sometimes called a promissory note, we're saying, okay, here's this money, but we expect you to pay us back the principal, the $100, plus interest on some certain due date. And so the maturity date is the date when the receivable is due. And just to be aware, if a note is less than a year, it's still recorded as a current asset. But if it's greater than a year, then it will be a long-term asset. And so then that's then broken down. So if it's like a 2-year, whatever is due within the year is considered current, and whatever is due beyond the year is considered long-term. Then there's other types of receivables that you might see. And so we're just talking about, accounts receivable and notes receivable are going to be the most common thing we're going to see. But then there could be other things like dividends receivable, interest receivable, tax receivable, bond receivable, mortgage receivable, so rent receivable, whatever. There could be lots of different things with that receivable at the end of it. And those would just be other less common types of receivables. And as I said in the previous slide, they're classified as current or long-term depending on if they'll be received within the year, then they're current. If not, then they're long-term. Then the chapter starts to talk about internal control over receivables. And as we talked about in Chapter 7, it's important that internal controls are in place to minimize the wasting or theft, or just to safeguard our assets. And so cash is a major asset, the most liquid asset, and if that one is not protected, then it typically walks away. So some of the internal controls would be like when there's cash payments received by the mail, it needs to have that separation of the cash handling versus the cash accounting duties. So whoever is receiving the check shouldn't be the one that is updating the accounting records. And also, the credit department should not have access to cash, and those that do have access to the cash should not be in the position to grant credit to customers. And so that's just one of those separations of duties, and so that's an internal control that should be in place when you're looking at receivables. And sorry, I was just trying to think about how much further I want to go with that. Just a little further expansion on that. So if the credit department employee does handle cash, he or she could pocket the cash because they could label a customer account as uncollectible. And so then the company would stop billing that customer, but they could have just kept the cash that was received, and then nobody would ever know. And so that creates kind of like the perfect scenario for an employee to disguise their theft, and that is why that separation needs to exist. As far as the journal entry for recording sales on credit, this is what we've done in a previous chapter where we've shown a debit to the accounts receivable and a credit to service revenue, or a credit to sales revenue. But the difference here is now we're saying accounts receivable and we're putting the person's name, so in this case Brown, behind it. And by doing that, we're creating a subsidiary ledger where we're going to track our customer Brown and all of that person's receivables, and then we'll combine all of our subsidiary ledgers to report one single accounts receivable value on our financial statements. But internally, we can see every customer and what their balance is at any given time. And so this, this slide shows where we have the subsidiary accounts for each specific customer and how that is then collapsed into the one control account being accounts receivable, where we see the grand total of $15,000. And this accounts receivable is what would be reported on our financial statements, whereas these subsidiary ledgers would be monitored internally to determine if a customer might be considered uncollectible or is past due and we need to follow up with them, and so on. So then when we actually collect cash from the customers, that's a debit to cash showing that we're increasing the cash asset, and a credit to each accounts receivable account that we collected from, each customer specifically. And then again, we can just see that now that we have a $2,000 balance for Smith, but collectively on the accounts receivable, we're showing a $3,000 balance on our financial statements. As far as decreasing